The 10-year US Treasury yield just hit a 15-year high. What this could mean for the safety of your portfolio.
Once there becomes an element of instability in risk-free, then the question arises, are the other assets actually as risky as we thought they were? Or contrarily, are they all just much more risky?
And this is my 50th episode, so I thought we should take a look at the best insights we've seen from executives so far. And I'll give you my take on where I think our biggest companies are at. It's Friday, the 1st of September, and you're watching Markets with Madison. What fund managers thought they knew about fixed income just flipped. The US 10-year Treasury yield just hit 4.34%, its highest level since before the GFC. The 10-year is a yield with a longer maturity than, say, the 2-year yield, so it's typically less sensitive to monetary policy moves from the Fed. So why is it moving so much? Well, Greg Fleming from Salt Funds is here to explain. Greg, what is going on?
Well, there's a lot of things going on, Madison. As you say, normally when you get to the end of an interest rate tightening cycle from a central bank, you would start to see the shorter dated bonds, like the 2-year, the 5-year, those sort of bonds that are immediately reflecting where the, in our case, official cash rate, in the US case, Fed funds rate is set, would start to move downwards. And then the longer end of the curve, which is the 10 to 30-year part in the US, would move also downwards. What we're seeing is kind of the converse of that. And that's because there's a lot more worry that inflation will last substantially longer. There's also other worries around, though, and they relate to credit sort of quality in a way. The risk-free nature of US sovereign debt has been a kind of taken for granted basis for universal finance for 50 or 60 years. There was a credit downgrade from the Fitch rating agency, which took the US rating down, based basically on three things. One, the US government can't stop fighting, can't stop spending, and won't raise taxes. And given those three things, the market is starting to worry whether it is truly as risk-free as we've all assumed for all these decades.
If you could rate those factors, do you think that the US credit downgrade was one of the most major ones, or was there something else at play?
I think that there's a lot of signaling going on from the rating agencies, and the signaling relates to wanting more maturity in government discussion of fiscal policy. I think this year it's become pretty clear that some governments are in a kind of fiscal fantasy land. That is, they are pretending that tax revenues are going to stay pretty strong, and they are not taking necessarily the fiscal adjustments that they should be taking, given the fact that the world growth is slowing quite sharply.
I was going to ask you, Greg, if you could establish how weird it is that that longer-term yield, the US 10-year, is moving, as opposed to the shorter-dated maturity bond. But that kind of explains it, doesn't it? So in your view, then, this isn't actually odd that it's moving so much.
No, it's not. It's, partly you can say that the market's reacted recently to this persistent inflation worry. And I think that's a fair, it's a fair explanation. But if you look out on a 10 or a 30-year bond, as they have in the US, they are much more sensitive to expectations of future inflation. So if there's no sense that governments are really serious about reining in inflationary spending, then that longer bond is going to suffer. And that's where you've seen the largest downward valuation shifts. I think that the reason the market is concerned about it is because there's a tendency in fiscal circles to basically just look at the current electoral cycle and to be caught up in risks going into the next election. So in the US, that's in November next year. Biden has gone on a very major spending binge in the last 2 years. And again, it's not a political view. It's just a reality that Biden felt that a lot of things were being underspent from a federal government point of view. And the Treasury has had to issue a huge volume of new bonds to finance that, at the same time as the Federal Reserve is theoretically meant to be reducing the stock of US government bonds it holds. So you can see already there's a tension in the market between those two forces. But, otherwise, you can see that there's a kind of a belief in the US Treasury that we can ride through the next electoral cycle and things will work out. But the US federal debt is closing in on 33 trillion US dollars. That's 55 trillion New Zealand dollars. The service burden of that debt at the current interest rate level is around $1 trillion US dollars a year coming up going forward. So it's a major, major burden.
So, if you're expecting more supply of bonds to come into the market, then I take it that your view is that this is a trend that's going to continue?
It's a trend everyone has to be aware of. The old assumption that the investment world just soaks up new issuance of government bonds like a sponge has to be questioned, because the willingness of investors to go in there is diminished for sure. Especially now, there are some good quality corporate bonds. There are some other bonds that aren't reliant on tax revenues to fund their coupon payments that are available and much more accessible to investors than they were in the past. And you can look at their credit ratings pretty quickly in real time, as compared to, say, government credit ratings, which don't go out very often and aren't refreshed very often. So there are plenty of alternatives for investors, and governments have to be aware that they can go elsewhere than just buy into sovereign bonds.
Fixed income assets like this are typically more popular in more conservative portfolios. But did bonds just become a bit more risky, Greg?
It all goes back to that assumption of risk-free, and yes, they did. Risk-free really means that the government won't miss or defer a coupon payment, like an interest payment on its quarterly cycle, nor will it suffer a credit downgrade that will lead to people demanding more yield from the government next time it comes around to issuing its bonds to roll over the existing bonds. So, no, I think that you can't just assume that because taxes can be raised to pay out coupons, that we're in that old risk-free world anymore. People are increasingly cautious that the way that monetary and fiscal policy are meant to reinforce each other has kind of got out of whack, and that monetary policy and fiscal policy are working against each other.
I want to ask you just quickly about the yield curve, and it has been inverted for a while, as we know. This is the spread between, say, the US 10-year and the US 2-year. And when this first happened, it was a signal that the US was heading for a recession. Everyone sort of freaked out. That obviously hasn't come to fruition. What do you think that this could mean, this US 10-year yield rally for that inversion?
Okay, yes, that's a really good point. I mean, the inversion is a little greater to some extent than we've seen previously. The leading indicator power of an inverted yield curve has its adherents and it has its detractors. The adherents point out to the fact that there's never been a sustained inverted yield curve without a recession down the track. The problem is the lead time. It can range between sort of 9 months and 3 years down the track. And that kind of makes it less helpful as a cycle predictor. Things have changed from when that relationship was first observed back in the 60s. There are a lot of other factors in play that might or might not allow a country to get out of recession, even if the yield curve is inverted. So I wouldn't draw too much implication from that, because if yields at the long end come up, as they have been coming up, the yield curve is getting flatter, and that actually would argue that the inversion had lessened, therefore the probability of recession had dropped. That's not necessarily the case.
Can you just quickly explain the relationship between price and yield when it comes to treasuries?
Yes, good point. I mean, the simple answer is that as yields go up, prices go down. As yields go down, prices go up. The reason for it really is that an existing bond has to compete with newly issued bonds. So if new bonds are being issued at higher yields, at higher interest rates, then the existing bond with a lower yield must become less valuable, other things being equal. So it's just sort of a mathematical seesaw by which bond portfolio managers work out what's worth something, what's worth less than it was, and how to position overall.
But ultimately, other than that explanation right there, anything and everything that fund managers thought they knew about fixed income is now fraught. Fair to say?
Yeah, I mean, this is a highly theory based world, and in bonds, probably more than in equities. There's 60 years worth of pricing models which rely on certain risk free securities as being a kind of baseline. If you're not willing to take risk, you stay in those. Then the more risk you're willing to take, you go higher out into that uncertainty space where you can't necessarily rely on earnings or on dividends or on bond coupons being paid, but you should be rewarded more for them. So once there becomes an element of instability in risk-free, then the question arises, are the other assets actually as risky as we thought they were? Or contrarily, are they all just much more risky? So people have to kind of revisit their assumptions about risk and their own risk tolerance.
So much to think about. Thank you for that explanation, Greg. I really appreciate it.
My pleasure. Thank you, Madison. Great to talk.
Can you believe that we're at episode 50? I came up with the idea for this show while I was working for an investment bank. I'm honestly not kidding. I still have the notes on my phone from late last year. We launched the show in Feb. We spent about 3 months behind the scenes putting it all together just before we launched it. And while there is still so much more, and I think better content still to come, I just wanted to say thank you for watching, engaging, telling me what you want more of, less of. It's all valuable to me. This show is all about giving you access to executives and experts, revealing how they think so that you can make more informed investment decisions. And honestly, it's actually just a hell of a lot of fun. If you haven't watched from day one though, here's some insights that you may have missed.
Innovation solves problems. Now, what's the big problem we're going to have in recession? Companies are going to have major margin problems.
What's it like going up against Elon Musk?
Oh, Elon's just a guy. Because it's so insanely hard to go to orbit and there's only just a few of us that have got there, there's kind of a mutual respect.
We are discretionary, but I think we're less discretionary than, say, a fashion business.
How much of a risk is that, do you think, in terms of consumer behaviour, now that they know that they are being charged more for certain products and can get it cheaper elsewhere?
Look, it has had a bit of an impact on margins.
We've actually put up deposit rates more than we've put up lending rate over the time since the OCR increased.
Does the lack of stress in the system currently surprise you?
Yeah, I'm really surprised. I've been looking for ages actually. In fact, if you go back and look at some of my public comments when COVID came around, I was really negative and it proved to be wrong.
You were.
I was completely wrong, and the reason for that was I underestimated how much governments would flood the economy with liquidity.
In hindsight, we could have started restricting the interest rate sooner.
We suspect after inflation has been so high for so long, it just might take a little bit more.
That's a complicated question.
The best ones are. Have you pushed price increases through to customers, and are you then telling us that you'll remove those once the inflation pressure eases off?
Temporarily, yes, we are actually suffering in that sense, but we think that the price increases that we're doing are the right ones.
We've seen really significant increases in rents, so actually 17% increases, 16.9% increase on the previous rent.
We think you have to get the balance right between what you contribute to shareholders, what you have for customers, and what you contribute to your employees.
Briscoe doesn't actually have any term debt, according to your most recent report. Do you think that's unusual?
Who do they think is going to fund this stuff, and why would you care?
Are we really confident about the long-term future of this business? Of course. I told the owner of this business to...
I might use words like that at home, in my darkest
hour. You're welcome to use them here. This is a safe space, Ross.
During buoyant times, an analyst will tell you that we have a very, very lazy balance sheet. In times that are tough, where interest rates are high, they'll tell you that we're a genius. So, look, it depends.
Now, a question that I'm asked all the time is what I think of where New Zealand companies are at. This is no official advice, it's just simply my observations. Our major companies have had a really noisy couple of years. They did well through COVID, they survived, some even thrived. Banks kept lending, transport kept freight moving, house prices, as we know, kept flying, and us consumers kept on buying. And to be honest, I kind of just came off profits. It was just a hold on and get through it strategy and mentality. If you made money, well, great. But the party's over, and all of that noise of the past 3, even 4 years is quietening down. What we're in now is actually harder. Inflation is still coming through in costs, but businesses have already passed so much of it on. Higher interest rates have made their debt more concerning, and it's also hurting borrowers, making them harder to sell to, and tightening the screw on bank margins. Not to mention a few cyclones and floods in the mix just to really spice things up too. CEOs that I've spoken to, I'd say, are realistic. They're hyper-aware of the challenges, but they're also looking beyond it. While they're not being overly optimistic, they are continuing to keep an eye on opportunities, because they know that business is just a cycle. Good times to bad times, and eventually back to good again. I'll keep talking to them so that you can see how they're responding for yourself. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.